let's see how this turns out. Let me see if you guys are able to see me clearly. Yeah, you should be able to see me now. We're live. Great. Huh. Okay, so just again, few things that we need to talk about before the end of the week. Few things that happened during the week. Uh, you had some data that did come out about the American equities. You had some of that came in. You had some earnings that came in from the big tech. So you had Google as well as Tesla come out. Next week, we're going to be getting Apple. We're going to be getting Meta. We're going to be getting Microsoft. So we're going to go over those numbers as well. We are going to talk about a phenomenon that happens within the financial markets. So during the summer. So I'll talk about that. And we'll go over a few things about the unemployment rate, the unemployment claims that came out the other day. How does the jobs market look? What does it seem like? Is it going to get worse? Is it going to get better? What's exactly going to be happening there? So let's see how that turns out. Let me just put this link up on Twitter as well. So we can get people coming in from there. Everyone that's here, go ahead and say hi while I do this. You should also be seeing, there is a poll. I remember putting a poll. So, yeah, we're going to be talking about the Sydney Sweeney effect as well. No, we're not. But yeah, it's just incredible. All you need is Sydney Sweeney and AI at this moment to come together for a company, and stocks will go up. Hello, hello. Uh, and then we're going to talk about, we'll go about the Google and Tesla earnings that came, especially about the digital advertising market. And the other one that we'll do is Powell and Trump that happened yesterday. So it's not going to be too long. I'm going to try finishing it up soon. Let me just do this. Mm-hmm. Okay, we're good. Yep. Okay. So let's go ahead with the unemployment claims. Yesterday you got the unemployment claims for the week. Now this is something that I look at for a quite a while because it is the barometer to figuring out whether the economy is getting worse or better. It is also the leading indicator to knowing how the jobs market is doing. So remember, there's only two things that matter for a stock and for the economy. The single thing that matters for stocks is earnings. If the earnings keep growing, whether the PE ratio is high, the PE ratio is low, that's a game of overvaluation and undervaluation, and you can play that accordingly. That is one. Two, in more important news, the economy is the jobs market. If people are being laid off, the economy is going to do worse. And you're going to start seeing those in the earnings of these stocks. So it's never a scenario where you have to make it worried about, oh my God, tariffs are coming, something else is coming, something ordinary is coming. Trump and Powell are going to be having an issue and they're going to all of that. We've been saying this on the live for quite a while, right? So go ahead, subscribe. Make sure you go and answer the question that you're seeing up there right in front of you. The question is, how are you feeling about the markets after this wild week? Right? I'm still guessing we're going to go higher, but who knows? We're pretty much ripe for a pullback at this moment, is what I would say. Anyways, so the jobs market is the most important market for, if you characterize it for any form of a recession indicator or a boom indicator. When the unemployment rate stays steady, which is what it's been, and tick, I mean, literally ticking lower, and if the unemployment claims, which is the number of people that are coming in to say, hey, we're without a job, can you please give me unemployment insurance claims, unemployment money because I'm without a job. Can you please provide for me? The government is who they speak to. When those numbers start picking up or start moving with a volatility higher than average, you will start seeing the economy in a worse off place. Now, the numbers were picking up since the tariffs came through. They were moving from a 210, 220 all the way up to a 250. They were never breaking out of the 250 range. They didn't go up to the 260, 270, and that's what a lot of people were expecting, but that didn't happen. That being said, you have started seeing a gradual rewind of those unemployment claims have started coming lower. The unemployment numbers that came out as of they came out yesterday, yeah. So they were expected to be at 227,000. Now that's a lot of jobs that were expected for unemployment insurance. A lot of people come out and say, okay, we lost our job. Can you give us unemployment money? The number came in at 270. It came in 10,000 lower than estimate. So it wasn't a bad number. It was actually a very good number. A lot of people get a little confused when it comes to that. A lower unemployment claims is always a better scenario. It means more people are working in the system, more people are working in the economy, and you get to make more money. And less people, let's say, going in for unemployment claims basically means that the unemployment rate stays steady as well. Remember, the unemployment rate had dropped from 4.2 to 4.1, while the market was expecting an increase of 0.1, which was from 4.2 to 4.3. So when you get unemployment rates going lower, when you get unemployment claims coming lower, and a strong jobs market, you will tend to see the market making new highs and heading high. Now, how high is high? Nobody knows. It can be crazy. It can go. They can be stay overvalued for a way longer period of time than you can imagine. Anyways, that's about the unemployment claims that came out. You also had two data, basically, I think, yeah, two kinds of data that came out, which was the manufacturing PMI as well as the flash services PMI that came out yesterday. One of them was better, one of them was worse. Remember, how do you look at PMI data? PMI is something called as Purchasing Manufacturers Index, right? It's on a ratio of plus 50 minus 50. You don't need to break your head too much on it. If the number is above 50, means the economy is expanding. If the number is below 50, means the economy is contracting. So the flash manufacturing PMI came out at 49.5, whereas the flash services PMI came above 50. Remember, the services matters a lot. Even though the manufacturing PMI will start picking up because you're getting all of this tariff money coming in and you're going to see a lot of make in America kind of factories being set up. So you'll see the manufacturing PMI pick up. It's not going to be happening ASAP. It's going to take some time for it to trickle into the numbers. Just like the inflation from tariffs will take a bit longer than people expect. So the number that you look for is the services PMI, because America being a services economy, you want the PMI on that to be above 50. It was expected at 53, but the good part is it came in at 55.2. That basically means that the expansion in the economy is larger within the services sector and not as bad as people think. When you see such kind of moves happen, never look at it this way that, okay, if the unemployment rate is high or the unemployment claims is high or the services PMI is low, it's a bad scenario. You need to look at all of these together and try seeing, are we getting better month on month or are we getting worse month on month? At this moment, with the month of July currently there, and if you look at the tariff situation that was there in the previous month, we are improving. The unemployment rate has come lower from 4.2 to 4.1. The jobs market is steady. You have got a decent number that came in last time. We should be getting a new number coming in on the first Thursday of every month. So you're going to see it come through on the first week of August. The Fed is not going to be cutting. They're meeting in exactly 7 days from now. So in a week from now, the Fed is going to be meeting. And the Fed more than likely is not going to cut because of the reasons that I've given you in the past few minutes. The economy is super strong. The job market is not an issue. Inflation is not an issue. It's on its way lower. Even though some amount of tariff inflation has been creeping into the markets, that has been overshadowed because of the shelter inflation, which is the amount people are paying for rentals in America over the past few years, is now dropping in the past few months. So that's causing an effect to keep the inflation rates lower. That being said, if the shelter inflation comes lower and starts steadying itself and you start seeing a rally on the way up, right? You would then have to look at it and be worried about the fact that inflation can pick up. Remember, the game here is not whether inflation is higher month on month or lower month on month. The only thing that matters here with inflation is that is it on a trajectory moving higher? Because once inflation is set ablaze, it will keep, it's like a forest fire. It will just keep going. It's very, very tough to control. It's more than likely you're not going to be able to control inflation once it's on its way unless you start hiking rates. And when that does happen, it kind of becomes an issue. You saw that in 2022 when you saw this entire market literally go to the shitters. Everything fell. All stocks were down. Netflix was down 70%. And Meta was down about 70, 75%. I think Netflix was down more than 70%. So everyone that looks at the chart today and looks at 1100 on Netflix, remember exactly 3 years back, you had Netflix somewhere in October 2022. You had October 2022 to May of 2023, Netflix was at 180, $200 stock. So just saying, don't go by this concept saying that, okay, you can't get overvalued, you can't get undervalued. Both of those could happen. So just know with your boundaries that are there. But usually when you see an economy, it becomes the stock market is the barometer for the economy. And when you look at the economy, you're able to figure out and see how much of this growth is taking place. When you look at the economy, just by the way it is currently at this moment, with an unemployment rate that's lower, with the claims that's lower, with a GDP that's moving higher. Let me actually check what the Atlanta Fed GDP is now. You all can go to atlantafed.org and look at this concept as to what the current GDP is expected for the month. So for the second quarter, right now we're expecting as of the estimate is of 2.4%. Remember, we were in a negative number previously, and now people were expecting, okay, America is going to be going into a recession. Not happening. That was a instance of GDP import of gold imports that was currently going on. None of that is currently going on at this moment. 2.4% is what you're seeing as the GDP estimate for the current year, for the current quarter. So the GDP is great. Unemployment's not an issue. Jobs market is great. You are looking at a lot of these numbers playing out pretty well for the economy. So you are going to see stocks move higher. Now, the jobs market is what is important. So we need to keep an eye out for the unemployment rate. We need to keep an eye out for the non-farm payroll. How does this play out over the next month and over the next few months? Will let us know if the Fed can cut rates, right? Remember, when the Fed cuts rates, at this moment, it'll be the biggest beneficiary of Fed rate cutting is not just the banks. It is also mortgage companies. It is also the consumer because they will most likely have a lower mortgage rate, leading to people wanting to go out and buy homes. The the housing market in America is literally come to a standstill. No one's able to sell their house. No one's able to buy their house. Now, inadvertently, you will see a few people saying that they've sold it for about 20 million. Some of them have sold it for 10 million. But the normal middle consumer, but the normal guy who's basically trying to buy or sell a house is not able to do it. Is because either the interest rate's too high or his demand is not available because no one's able to buy his house. Now, that is an issue. So the Fed cutting rates is going to restart the housing market. But remember, the restart in the housing market is not going to come because of a 25 basis point cut. It is only going to come through because of if you are dropping the interest rate by 1% or 50 basis point, it is then more than likely that you will start seeing an effect on the real estate market. Remember, construction spending, real estate, new home sales, these things matter a lot for the economy as a whole, not as much for the stock market. But if this cycle picks up with real estate, you can start seeing more amount of employment being created, more amount of jobs being created within the construction sector, within the housing sector. The home builder stocks, which have been literally laggards at this moment, they've not been doing pretty well. They will start performing and you start getting breadth. Now, what do I mean by breadth? You basically start getting more stocks following the index or doing better than the index. So not at all points of times will you see all sectors of the economy doing well. At some times you will see some sectors doing well. Like at this moment, technology, industrials, financials are the best sectors. The worst sectors that you're looking at are healthcare, home builders, all of these. They're not been doing well. So if you are able to even light a small fire in order to basically ignite the housing market sales, you can then eventually see this coming into the numbers that can make the Fed increase the speed at which they're going to be cutting. Now, a few days back, you had President Trump coming out and saying that it did look likely that he was thinking of putting no capital gains on people selling their homes for people that basically have their primary residence or anything like that, up to a capital gain of up to $500,000 US. It's very beneficial if that does happen. It's very unlikely that it will happen because it's not so easy to just go in and take that money out, because remember, it's a balancing budget. If you're dropping the money from a capital gains tax, you need to get it from somewhere else, right? Obviously you might raise your tariffs on a few other things, like the other live we were talking about the US Japan trade deal and how beneficial it is for America. It similarly can be beneficial for the housing sector if President Trump is able to come up with some scenario which can at least restart the housing and construction spending. It'll at least give us some sign of a relief among the real estate, let's say the real estate stocks. Forget about the entire sector in general. And once that stock market sector of real estate starts picking up, you can see a lot of that come through into the index. So you will see a pickup in the index then, led by companies that are not just technology and financials. So that means now instead of, you'll have it firing on all cylinders and not just on these two or three cylinders currently that we have been firing on. That being said, if you can get that done, it looks very likely that you will now be able to see higher stock prices in the years to come. Again, do remember that this is something that the market does go on with, which is called as the summer of George. The summer of George is basically a period between June, July, August, September. Maybe not September to that much, but it's basically light volatility, exceedingly light activity. People are basically doing nothing. It's basically done as a way to look at saying that George, as a person who's a trader or as an investor, is basically he's just relaxing and he's taking the summer off. A lot of investors and traders take the summer off. They don't usually do a lot of active trading. And it also sets up for complacency. So you can get bigger moves, you can get markets going either way higher than required, or you can feel the market's going way lower. And even if they do go higher, a lot of people look back and are like, okay, you know what? Investors, they feel like there's no need to act at this moment. It's just the summer vibes that they have, which basically they just sit back and do absolutely nothing. Anyways, now in this summer of George concept within finance that happens, you will start seeing the markets usually grind higher. And towards the end of summer, they start having a setback. Now, the setback comes because of overconfidence. Why? Because as the market keeps going higher, most people don't come in and join that rally. And the markets then eventually start tapering lower. And in the start, it is a few percentage points. And then eventually it leads up to 5 and 7 and 8 percentage points. You had this last August with the Japanese yen carry trade issue. Same story in August. August 5th is when it happened. You've been having this around this time. So markets usually come in and have a bad August, September, October. And I wouldn't say bad in the sense, don't take it as it's going to be a crash of like 10, 20%. That's not what I'm saying. It's just that the volumes are light, the volatility is low. If you look at the VIX right now, you're below 15. You don't usually see that. Those are clear signs of a bull market, but those are also signs of a summer market where volatility is not the talk of town. You're not seeing 2% moves on the upside, neither are you seeing 2% moves on the downside. It's literal dead momentum that's going on in the market. What is important for you to know is that look for sectors that outperform and go out and buy those stocks. Those are the ones that tend to do better, right? Most investors don't go in and invest during the summer because they feel like they can just keep riding this wave of markets going higher and we can keep making money till you get this setback because no one's buying. Eventually, people stop buying. And if people stop buying, you're going to start having more people selling. then that's towards the end of the year, towards the end of summer, not towards the end of the year. And you start seeing the market actually go way lower, sometimes 5%, 6%, 7%. And once you're through into that, you start also looking at the markets kind of forming a low around the October, November period or earlier. And everyone then just goes all in, and basically the retail and the Santa Claus rally, and there's just leverage that comes back into the system. There's just volatility and leverage that comes back into the system, and you get this crazy move all the way upwards. Now, for a lot of you that are thinking as to how is the best thing that you can do, remember the last 2 weeks of December and the first 2 weeks of January. So basically, the last 2 weeks of the year that you're in and the new year that you enter in are usually historically the most bullish 4 weeks. Usually, also when the market does make a new high, is in Q4, so which is your October, November, December quarter. And usually the markets always go high in the last 2 weeks of the current year that you are in and the next 2 weeks after. So look at that. You will then see a lot of these leveraged moves happening. You will see a lot of these stocks moving higher. And next year, what again I do believe is that there is going to be a large amount of a move from the industry and the Trump administration to make the stock markets go higher as well as the economy better, because next November you have midterm elections in America. For everyone, this new year, I've been saying this before as well. So the quarter in which you have the midterm elections, which is next November, and the 2 quarters after that, right, is when you basically see the largest amount of stock market returns. The best 3 quarters that you basically get in an election period is the November quarter when the midterm elections happen, and the 2 quarters after that. Now, this is the whole game in town when a lot of the money comes in because they rig this economy up and they rig this market up. You can go back and check in time. There's no manipulation that happens. There's basically systems where they're not ready to give out a lot of the bad news because they want the economy and the stock market to look better, and because of which they can continue winning the election. This is the same thing that happens with the general election that happens. You usually ride up this wave, and on this wave higher, when this is something that everyone should know, they usually rig up the entire stock market to rally up until the general election results. So if you see, the stock market kept rallying into 2024 all the way up till November 5th when you had Trump come in and win. And after that, you've been seeing the markets being steady and then lower again in April. Though all said and done, what I'm trying to say here is that the period of 9 months where you all can make a lot of money is coming next year, somewhere around the midterm elections, the quarter in which the midterms happen, and the 2 quarters post that. Anecdotally, historically, they have been the most bullish period for investors. So that is something that everyone should look at, because you will start seeing this move higher, and stocks can actually rally into the next year, right? What's up, bro? Hello. As of now, it looks like companies are eating up the tariffs, not the customers. Uh, See, at the end of the day, the customer has to eat the tariff. So, uh, Jeff Bezos also came out and said, I think to Trump or something in their backdoor meeting, which got leaked, that, or with Secretary Bessent, that he's not increasing prices on Amazon, even though it's all said and done, prices have increased. So he can say what he wants, but the prices have increased. So people that do follow Amazon pricing have realized there's a tracker online that you can figure out. A lot of the necessities as well as normal products that people do buy, prices have gone in America because of tariffs. So when they say they're going to be making 200 billion, 300 billion in tariff income, that income is coming from somewhere, and the the company at the end of the day is not going to take up the tariff, is because the only reason being it's the customer that wants the product. So it's the customer that pays for it. The maybe the company does take in the few percentage points into their balance sheet just so that somebody can continue buying from their place without them losing market share. How long can this go on for is important, which is why I keep saying please look at all points of time as to how the inflation numbers do. Remember, price increases because of tariffs are a one-time solution. But if inflation keeps picking up and starts picking up again, it's not been a talk of town and it's not happening at this moment. But if it does, now what do you do when you have a tariff effect as well as you have inflation? That starts making things worse. Now, I'm not saying that's going to happen. I don't believe it's going to happen, is because I still believe that all the tariff rates that you're talking about and seeing at this moment with the administration are always up for negotiation. No trade deal has been signed. The only trade deals that have been signed are frameworks to make the trade deal. So things can always change. And what I believe is the administration wants to keep negotiating for the next 4 years. So they're okay with negotiating on everything and anything. They're completely okay with the fact of continuously talking about this is a better deal, that is a better deal, this is better, that is better. This is just their way of continuously doing it. So I would say the less time we spend on tariffs, the better we'll get as investors, because in 2025, and especially with this administration, at least for the next 4 years, this is the story. Nothing is permanent, everything is temporary. Whatever you thought was there 3 months back is not there today. Whatever rates you spoke about 3 months back is not there today. Whatever business dealings and frameworks of trade deals were supposed to be happening 3 weeks back can completely be upended in the next 3 weeks. Everything is up for basically negotiation at this moment. Anyways, so that's the story with the jobs market. The unemployment claims came in at 217,000, so that was a good number. It does mean that the economy is supportive of a move higher. Stocks can continue. Just remember, like I've been saying, it's the summer of George at the moment. This is the period when equity prices can stay a bit subdued. They don't necessarily fall down from a cliff, neither do they keep going up like a rocket. Yes, there is some retail meme mania that's happening, and because of which you can see prices go higher for the certain stocks. But in general, the S&P and the Nasdaq have very low volatility. They're trading, the VIX is below 16. Usually at this period of the year, it does stay this way. I believe this is how it's going to continue all the way up till the Fed meeting, and the Fed meeting will also be a nothing burger, because it is just going to be the Fed coming out and saying the economy looks good, everything seems fine, unemployment's not an issue, inflation can still creep in because of the tariffs, because there is no certainty with the tariffs. So in all honesty, if I was Fed Chair Powell, I would have said the same thing, because the story is the same, right? 2 weeks back, we didn't know what the tariffs are. Today, we know what some tariffs are, but we don't know the effects of the tariffs. For a few countries, we don't even know what the tariffs are. So, and major trading partners is what I'm saying. So all of those effects put together can actually make these stocks go higher and can make the Fed not cut rates. I have always been part of this camp, which keeps telling to people that please go back and look in time. You will see there is a very high correlation with stock prices at the start of a bull cycle having higher interest rates or a hiking cycle. It is because of the certainty that the Fed tells you that they will control inflation because they have no other choice. It's their job, that the markets continue going higher. And just before that period, the Fed doesn't know exactly what it's doing, and that's the reason why stocks crater. And those are usually the best times in the world to go out and buy stocks, is when just before the Fed starts hiking and is in the process of hiking. Usually when the Fed cuts 25 basis points, 50 basis points, it's because the economy has been doing well. But do remember that that's not always the case. Eventually, at points of time, the Fed is also just having gunpowder, because if something breaks somewhere, you can see the Fed come in and act. And then they will bring it down to 2%, 3%, just like how they did it in COVID, just like how they did it during the global financial crisis. You don't know when it happens, but it will happen again. So it is just part of the way things happen in the economy, part of the way things happen with the Fed. You should know better by understanding that attempting to keep saying, can we drop the interest rates by 10%, 15 by a few percentage points and all of that, it's not really going to make too much sense. It's not going to move the needle other than the housing sector, which again will not move that much just because of a 25 to 50 basis point move. So that's not really going to be an important thing to consider here. Even Trump said earlier he's looking at the markets heading to all-time high. Yeah, the whole thing changed when he came out and said that good news was on the way. Now, what I do believe after seeing all of this entire circus that has been taking place in the past few weeks and months, that the reason why the tariffs were so strong and everything else is because maybe he wanted the Fed chair to react, maybe cut rates sooner, maybe make him feel like it's going to happen. But then they had to do a U because they realized that the Fed chair was not going to cave in and not going to cut, because he basically turned around and said, it's a you problem, you fix it. So he had to bring that down because the 10 years started spiking beyond control. And when the 10 years starts spiking beyond control, you start seeing equity returns being diminished because people start moving towards bond markets, and bond markets tend to give you better return where it's at higher prices because you're not going to see larger amount of uncertainty. And at the same time, you also saw the dollar being sold off. So I think he realized that he's doing himself more harm. And he also did realize that the Fed chair is not going to be somebody who's going to come in and be there at all points of time trying to solve this for him. That being said, as of now, if you look at the video that came out yesterday when they both met at the Federal Reserve, newly reconstructing whatever the hell they're doing out there worth 3 billion US dollars or 2.5 billion US dollars that they're trying to fix there and remodel and get marble floors and everything else. What they're trying to fix there is basically Trump's trying to go in and still strong arm him, saying, hey, if you were thinking of 25 basis points, do a 50. If you were thinking of nothing, do a 25 basis point cut. Help me somewhat so I have less interest burden to pay. And if I have less interest burden to pay, because America has a huge debt burden at this moment, which is close to crossing, from what I remember, it is close to even crossing all of their social security and their healthcare. And I think their defense budget to a certain extent also. It's about 900 billion or $1 trillion. If this goes on for a few more years or more, very likely that the largest portion of their debt would be just interest. So it is on an unsustainable path. It's not going to continue this way. So that actually works out for them, trying to figure out that, okay, can we have these scenarios where the market can react? Maybe Fed chair caves in, maybe he comes in and cuts 25, but I don't think that's the scenario that's going to happen. The Fed is pretty smart. They're pretty independent. They know they can't be fired. So in a way, that does work out for them when that's the story. Do we expect rate cuts next month? Uh, I mean, we have a Fed meeting in the next week. There is no rate cut coming there for sure. The economy doesn't seem like it's weakening, though underlying there are a few cracks emerging, not just within, I wouldn't say within the jobs market, but within the housing market, the housing sector, and that's a very large sector. Real estate is one of the largest sectors in the world. So when you start seeing that having an issue, it can have an issue that can snowball into a larger issue. Again, the next meeting is, I think, Jackson Hole in September. I do expect a 25 basis point cut there. The cuts could become a 50 basis point if the incoming data starts getting worse. Now, by that, what do I mean? The only way I mean incoming data starts getting worse is that the jobs market starts looking weaker and inflation stays where it is or cooler. If inflation starts getting hotter, by that I mean if inflation starts picking up, then that's going to be an issue. Because then, if inflation's higher, you cannot be cutting rates. You cannot turbocharge an economy by cutting rates, even though you won't with the 25 basis points. But if a fall of 25 basis points does come through, or a cut of 25 basis points does come through, while inflation is picking higher, they can't do that, right? That's not part of their mandate. The part of their mandate is not cutting rates. The part of the mandate is two-pronged. One, they need to make sure that the unemployment rate is low and the jobs market is healthy. And the second one is that inflation is under control. So the jobs market doing well. The only one left for them is the inflation part. Now, if inflation even starts having slight ticks up all the way up to September's Jackson Hole meeting, not too sure that they will cut. Again, this is my viewpoint. The further the rate cut is, the larger this bull market will get. Now, yes, the housing sector, home builder stocks, they might not do well, but everything else around it can do very well. And the markets can actually keep rallying for the next 9 months, even if we don't get rate cuts. The rate cut only supports the housing sector and to a certain extent some of the banking stocks. 25 basis points is not, no one is saying that, okay, my mortgage rate is 6.75. If it becomes 6.6, I will buy a house. No. People go out and buy houses when 6.75 becomes 6, 6.25, 5.75, 5.5. So you need 0.5% to 1% or more of a fall in order to start seeing that actually trickle through into the real estate sector and the housing market. So 25 basis points is not going to cut it. Though I do believe that what they will say in the July meeting is that if the incoming data continues being the way it is, they will be on a path of rate cuts. That way, they could keep the entire noise coming out of the Trump administration quiet, because the Trump administration has realized that there's nothing they can do to coerce this man. So they have literally come out and said that, you know what, we can't even fire him. Let him just continue. They'll just keep harping on this fact it's too late and keep cutting too late, this, that, all of that. But that's my story. I believe that if the Fed can telegraph rate cuts for the rest of the year and not do it, the market will do way better. Why does the Fed need to cut rates? The Fed only needs to cut rates when the economy looks like it's not doing well, right? If the jobs market is not doing well, the Fed should cut rates. The Fed is not supposed to be cutting rates to make the economy hotter than it already is. And yesterday, if you go out and watch the Trump and Fed meeting, you will see that Trump at the end of all of that did say that the economy is hot and is doing very well. If you use the word the economy is hot, it basically means that it's against this concept that the Fed should cut rates. The Fed is only supposed to be cutting rates when the economy is looking like it could get worse, not better. So I don't know what's going to happen about the Trump administration's belief with Powell or cutting rates. I do know that the only reason they want to cut rates is because they want the interest burden on the debt to reduce, so they can then say that they have balanced the budget, because, and it is going to happen because the tariff revenue is going to eventually overpower the interest burden at some point of time, and you are going to continue making some money there, because remember, once you start having a 10-15% tariff, it sticks. Consumers will just pay it because they might not pay it in the start. Eventually they need it, so they'll buy it and then they'll pay for it. When they pay for it, they're eventually going to start looking at those prices and continue, right? Like a lot of people today look at prices and are like, 4 years back it was so different. Yes, but you're still buying everything. You're still doing the same thing. So people adjust, consumers adjust. The American consumer for sure adjusts. The American consumer, whether it's a good day or a bad day, likes to spend, and they like shopping, so they will continue doing that. If you look at the retail sales data that came out, also phenomenal data. People are still spending. Look at the Bank of America credit card spending report. People are spending. Credit card spending has picked up. Delinquencies haven't. So what are delinquencies? People missing out on their payments and not being able to make payments. Basically, people that are biting more than they can chew. It's not a number that's currently ticking up. I mean, it is. When I say it's not ticking up, I'm saying it's not getting crazy. So it's not like it's becoming a larger issue than people can imagine. That being said, uh, yesterday's Powell and Trump's meeting, as well as do remember that within all of this, the Secretary of the Treasury is important. Scott Bessent every Monday will meets. Basically, the Treasury Secretary meets the Fed chair every Monday for breakfast. It's basically a thing that happens. So obviously they have spoken. Obviously he's told him that, hey, listen, you know what? You need to cut rates. This man's going to continue talking about you, not cutting rates, but we're not going to fire you. Continue doing what you're doing. So everyone knows that that's the story, but everyone's just pushing to see. This is something that I do like about Trump. It is against most people's popular opinion. But one thing I will give him is the fact that he will push every industry, every country, every institution to the brim. He will push them to the limit and then see how they react. I saw that start off with, I think it was Puerto Rico, when he put in tariffs overnight, saying if they're not taking their people back, and illegal aliens and illegal civilians or illegal immigrants and all of that, he's gonna put a tariff, and overnight they accepted their people back. And I started realizing there that it's more of a negotiating tactic, but at the same time, a lot of this has to do with, he wants to punch you the hardest as much as he can and then see how you react. He's trying to do the same. He tried to do that with China. He saw China reacting. He kept going. And then eventually he realized that, both realized that it's on an unsustainable path. So they started realizing, okay, let's pare back. He's done that with India. He's done that with Japan. He's done that. And with the Japanese, he got the greatest deal of ever. Like, in all seriousness, if there was a better deal, I don't know about it. But if the Japanese are going to give money to the Americans for the Americans to build factories, and they're going to not just, they're going to get back only 10% of it as profits, that is money that the Americans are going to just keep with them. So it's just phenomenal. It's a phenomenal deal for the Americans and a shitty deal for the Japanese. But for the Japanese, the good part in all of this was that they can sell their cars in America at a 15% tariff, while American companies like GM and Ford, who build their factories in Mexico, will have to send a lot of their products back at a 25% tariff. So more than likely that the Japanese cars will be sold more than the American cars because of this, which is why you saw Toyota and Mitsubishi. I think it was Toyota and one other company, not Mitsubishi, but Toyota was up about 12% on this news. Anyways, so that's that. Let me see what's happening with the market. It just opened, we're down about 29 points on the Nasdaq. Again, remember, volatility is only at 15.27, so you're not going to see stocks either crumbling like crazy or going higher like crazy. It's just part of this whole game that's currently going on. The Dow is up about 65 points. The Russell is flat, about 6 points higher. The S&P 7 points higher. Anyways, so it's nothing too much to look into. It's just a flat day. This is how the summers are usually for stocks. So just something to keep a watch on. Let me see if there is any stocks that are moving. So yesterday we did have Google and Tesla that came out of their earnings. We'll go a bit into it. I don't want to take up too much of my time on that. And let me first just see what's happening currently with Google. It had a 1% move the other day. Okay, it's flat at 0.1, 0.2% higher. But Tesla was down about 8% the other day. Yesterday. Tesla is up about 1.7% at this moment. And there's this concept that's been going on that any form of Tesla pain is Uber's gain, and any form of Uber's pain is Tesla's gain at this moment. So Uber is down about 1.39%. It's at about $89. Was it about 97? Anyway, cryptos have fallen. I did see they were at 108, 123,000 was where the high was made on Bitcoin. Today at about 116,000. Ethereum is the only one I think that's holding steady. Most of them, XRP was at about $3.60, now down to about $3. So, anyways, so let's go over the Google and Tesla earnings that happened. Google's earnings blew out of the park. Google said they're going to be spending more money on the AI capex. They've increased it by $10 billion more, $10 or $15 billion more. And it is likely that that's going to continue because remember, none of them want to be, you can't be the second best AI model and expect to survive. So you have to be the best AI model, and Google at the moment is the best AI model. So it is about, by a wide margin, Gemini is way better than most other AI models. And that is one of the reasons why the stock has also had, I think, the past 10 or 12 trading sessions, it's been closing in the green. It's done pretty well. Stock's been rallying all throughout from $150, $160 to about $193, $194 for Google. And Google does look like it's going to break out into all-time highs, maybe even go 230, 240, because it is the, by traditional financial metrics, it is the most undervalued Mac 7 out there. So let's see what happens with Google. One of the good things with Google was that with the earnings was YouTube's digital advertising data was very, very strong. It was expected to be plus 9%. It came in at plus 12, plus 12 and a half or 13%. What that means is companies are still spending for advertisements. Companies are still spending on the digital side, which means there might be a positive effect for Reddit and Trade Desk because these are guys that do a lot of the digital platform. That being said, for Reddit, it would be great. Thoughts on Reddit? Yeah, exactly. On my bet on Reddit would be that a lot of people are looking at the daily active users. Those numbers I think are going to continue higher. I see a lot more people using it. I see a lot more people spending time on it. They are also going to most likely renegotiate their AI LLM deals that they have with OpenAI and Google. So that necessarily is going to give them a lot more money. They did it just before they IPO'd and they got about 150, 160 million. Somewhere around next year or the year after, they're going to renegotiate those deals. I am so sure they're not getting 150 million. They're going to be getting at least half a billion at that time. Now, that money is going to be, as of today, about 30%, 40% of their revenue. So they're going to have a digital advertising push. They're at the same time going to also be getting AI LLM money push. So their revenues could go from a $2 billion, $3 billion number to possibly a $7, $8 billion number in the years to come. I'm not saying that it's necessary for it to happen. It could take another 4 or 5 years before you see a $10 billion revenue number. But it is kind of a May 2023 meta moment for Reddit. If they are able to get their digital advertising book in order and grow it, which they are, it's not like they're not. Over time, this can be a $500, $700 stock. Remember, it's only a $27 billion stock. You do get the AI side of it as well. So you are seeing more people use it. If there are more users, it will bring in more advertisers because the advertising game is showing it to more eyeballs. And it's a two pronged approach, right? You basically remind those that know about your brand again, and you show the brand to new people. So the more users, the more marketing people come in there, the more advertising people come in there, and your product gets advertised, you pay for it. Eventually, Reddit takes a percentage out of it. Reddit makes more and more money from the digital side. They also start making more money because of more users putting in more text and more data into the platform. Their value increases for the AI LLMs. So the AI guys, the LLMs come in and say, hey, we need all of your data because now we need it in order to give better answers to our people so that there is no more AI LLM hallucinations that's been going on recently. And Reddit's going to be like, okay, but it cost you 150 million 3 years back. It is eventually going to cost you maybe 400 million now. And what is 400 million for a company that is raising tens of billions of dollars? Now, could they get sold out? Remember, Sam Altman also owns 9% of Reddit. So it's not something that he bought during the IPO. He bought it in 2013, 14. So he realizes the potential in it. He's still I think their largest single shareholder. Newhouse company owns about 30%, but other than that, I think Altman owns 9% as a single person. So he could very well just get a deal done for 400 million, 500 million. Remember, it's not unfathomable to see that happen. So is it priced to perfection? I think at this moment, if you buy it, you must realize that you're ready to hold it for at least the next 2 to 5 years. This is not a 6-month play because in 6 months it could go to 250, 270, and who knows what happens. Or it could just be a year. But the thing is that if you believe that the user count keeps increasing, which leads to higher monetization, like you're exactly saying, which is higher monetization on ads and higher monetization on artificial intelligence LLMs. Eventually, it becomes a longer term play, and this stock can now be worth $300, $400, $500. It was 270 exactly a year back. With the way this volatility happens on this stock, I would not be surprised even if it goes to 250 by year end. It's not something that I would expect never that it could happen. It could very well happen. And Maybe it could go to 500 in the years to come, and could be next year or the year after that. Remember, a lot of money also starts getting thrown in during the elections. So next year during midterm elections, for that period, you will start seeing not just stocks doing well, but you'll also start seeing a lot more advertising play out. When you see a lot more of this advertising play out through the digital means, it's going to be Meta advertising, Twitter advertising, or X advertising. It's going to be Instagram ads, Facebook ads. It's also going to be Reddit ads, which was not the case a few years back. But now, because of the number of users there, you can start seeing that increase higher. So it is going to get a lot more people there, and the products too sticky. Yeah, like I mean, I was not using Reddit a year back as much as I use it today, and it is on my front screen now. So for a lot of people, as this app starts becoming on their front screen, you're going to start seeing a zero get added to the $27 billion market cap. So it could, in the grand scheme of things, this can be a this has the growth potential. It has a total addressable market of trillions, and it can be worth half a trillion as well. It might be exceedingly far fetched for me to say that this could go to a half a trillion dollar company, but if it's got founder led management, it's got very good CEO. He's got a very good CEO out there. It's got a brilliant CFO and a COO. They are literally on the path. Their problem can only be if there is regulation that affects them, but that could have been said even about Meta. It could have been said about any of these other guys. They all seem to have powered on and done well. So Reddit could be one of the biggest plays in the next 5 years, maybe. And remember, I'm saying I am invested. So don't listen to what I'm saying. Do your own due diligence, and none of this is financial advice, but I am looking to basically see this through for years to come if they continue performing, right? If for some reason they're not able to do well for a quarter or two, I might even add in. It all depends on, do I see the number of users increasing, even if it's not at the way the analysts expect it to? And do I see the number of people that are on this platform increasing, which leads to digital advertising pickup? And eventually the AI LLM money that they make through OpenAI, Gemini, which is Google, and maybe even to Anthropic, because they have a deal with Anthropic. I mean, they don't have a deal with Anthropic. They didn't have a deal with Anthropic, but Anthropic was crawling all of their data, and now they basically, I think, sued Anthropic saying you're using our data without commercial licensing, so now you got to pay for it or whatever. Now, if that happens, that's just more money for Reddit. Thoughts on Eli Lilly, 45 billion? Yeah, so it is. I would choose Eli Lilly over Novo Nordisk and every other uh, obesity drug company, just because Eli Lilly is entrenched so very well into the American market and globally. They are a company that is just not betting on the GLP-1 drugs. While at the same time, I do believe that a lot more people would be better off, or would be more open to using GLP-1 weight loss drugs as a pill rather than an injection. So a lot many people will be like, okay, I don't want an injection on my hand or anywhere. I'm okay to just pop a pill. And if Eli Lilly is able to come out with that, which looks more than likely that they will, then that's a larger market share, a larger market for them, and the stock could be way above 1,000, 1,200. They could keep growing. My bet was always on this. Always buy the best company in the sector. They seem to always be able to. The reason why they're the best is because they have the best innovation, they have the best people working on it, they have the best, let's say, the best regulatory exposure in order to get things passed. And at the same time, it's this, when you are one of the best companies in your sector, you are also the least volatile in down markets. Now remember, it is okay to make 22% return instead of 24% return when your drawdown is only 5% versus a stock that gives you 25% return but can go down 25%. So you rather, because what is important in investing is knowing how do you react when the markets are down. Not selling at new highs usually works in your favor because markets continue going higher. It is how you react when things go lower. So Eli Lilly as a company would be my bet when it comes to GLP-1. It would be one of the best, by far the best at the moment, and I would still say 5 years out, they would still be the best when it comes to weight loss drugs, pharmaceuticals, anything in America. So I would say they could be a $2 trillion pharmaceutical company as well. They could be the first $2 trillion company. I think they're the first $1 trillion company whenever they did become. Or let me actually see if I can find out their market cap at the moment. I think it's a stock traded about 813, so it's about 771. So their all-time high was about 972. So they were about $900 billion market cap. They could be a $1 trillion company and go way higher from there also. So Eli Lilly is a great pick. It can really keep going high. So, anyways, about the what do we have for tomorrow? No, for next week we have Apple's earnings. Their iPhone sales is not really going to be a big, huge topic to talk about, but we'll talk about it. Uh, I think it's one company that has the most to gain from doing something in AI and has the most to lose and lost already by doing absolutely nothing. Siri is a complete joke of a product at this moment. It does not answer anything, and they need some form of an AI embedded into their system in order for them to be have an AI multiple on their stock. So if they're able to figure something out there and they're able to get their ball rolling there, this stock could be an all-time high in a matter of 3 to 6 months. Will they do it? Will they not do it? Who knows? It's Apple at the end of the day. They have usually, other than Beats, they have never done an acquisition of the size of scale of that. So any AI company at this moment that Apple would even be looking at should be at least a 10-20 billion dollar company. And the biggest investment that they have done till now has been in Beats, which was just 3 billion. So the reason why they haven't embedded is due to user and data privacy. I know, but the thing is, there is no value to keep saying user and data privacy like they're saying. But eventually, if the users are unhappy with the product, they will eventually go somewhere else. At this moment, everybody is still going with Apple is because their product is decent. The phone in itself is decent. The phone does everything that you wanted to do, and it's the best in the market. But if I keep going on as a company and keep saying, okay, privacy, data privacy, users, this, that, eventually people are going to run away and be like, hey, you know what? You're not even answering simple questions that I have. It's frustration that makes people choose another device. So they need to fix that. And when and if they do, I'm saying the stock could be way higher. There's a lot more negative in the stock than positive at this moment, already discounted. So it could very, very well be a company that could surprise a lot of us. And it's always been that way as well. So they could actually be doing phenomenally well. And that could be the story of Apple. And Apple could be, let's say, in the next 12 months, one of the best performing Mac 7s. One of the worst performing right now after Tesla is Apple. And it could be a 300. At 300, I think it would be matching up. So about 40%, 300 would make it about at $300 a share. It would still be at Nvidia's valuation today or around there. So they could do pretty well, and it could just keep going. Last question: AMD, second runner-up and underpriced. AMD will also do well, my friend. AMD. The only thing I'll tell you with AMD is if you're expecting AMD to do as well as Nvidia, no. Or how Nvidia has done in the past few years, if you're expecting that with AMD, no. The amount of money that had to be poured in AI, a large part of it is over, and a large part of it has gone to Nvidia. So expecting AMD to be having the same run up as what Nvidia has won't happen. Can AMD outperform Nvidia on a relative basis for the year to come? Very much so. It could. Even if they can take a very small amount of market share, it will help their uh, revenue profile as well as their earnings profile, and things can look a lot better. So if I had to make a bet between Nvidia and AMD, it depends on how much I'm risking. If I'm risking 10-20% of my portfolio, I would choose an Nvidia because I don't want it to have a large effect. If I was choosing something like a 4%, 5% of my portfolio, I would go AMD because then it would be a secondary and not one of my largest holdings, right? So based on that, I would then choose an AMD. It all depends on position sizing as well as capital allocation, the way you do it. That's what matters here. It's not if I'm able to put 25% and if this goes up 4 times, I'll be able to make my whole capital back. If you play that game, you'll lose. So That's not. It's not. I'm not saying you lose in the sense you lose money, but I'm saying it's not a method that you can replicate for the next 2 3 decades if this is what you aim to do, right? So Apple comes out with its earnings. Let's see what happens there. Meta comes out with its earnings again. Like Google, we're going to look at the advertising stuff because Meta is just an advertising beast. The effect that Meta will have on advertising will have a direct impact again on Trade Desk and Reddit. Meta at this moment is going to be releasing 30th July. So Wednesday post market, you should get Meta's earnings come through. And when do we have? Do we have Meta's earnings that come through exactly when the Fed is going to be speaking? When does the Fed speak? Let me get it. So the Fed is speaking on Wednesday at. Oh, okay. So they're going to be speaking about 2 hours before market close. So you can watch Jerome Powell with his speech, and then you can go straight away and watch Zuckerberg, and that's going to be fun. Anyways, so Meta's coming out, Microsoft's coming out with its OpenAI earnings and everything else around it. So that's also going to come through. So have a look at that. We will break down that as well. You will be seeing me coming live on Monday or Tuesday, depending on how interesting the weekend goes. And otherwise, if you guys have any questions, let me know while I go ahead and see what the hell happened to our question. So the question was, how are you feeling about the markets after this wild week? Uh, I guess most people did say to the moon, and a few people are waiting for Powell to blink. And anyways, let me just end this poll. So that's that. Anyways, guys, nice catching up with all of you all. I will see you all next week. Appreciate everyone tuning in. Thank you so much. Enjoy yourselves. Have a good weekend. Thank you, guys.